Hi, I'm Kathy Healy with Healy Wealth Management. Today we're here with John Healy, our Chief Investment Officer, to talk about risk. John, can you explain risk and talk about some of the types of risk that concern you as a portfolio manager?
Risk in investing refers to the possibility of losing some or all of your investment, or not achieving the expected return that you have for your portfolio. It represents the uncertainty associated with financial decisions and how they may impact your wealth. And as Warren Buffett said, the first objective in investing is to not lose money. And the second objective is to not forget the first. I joke around sometimes, I say it's Armageddon every day around here because we're always thinking about risk. And let me say, the first thing about investing that you need to pay attention to when you're investing is risk. There is no investing without thinking and analyzing and understanding, trying to get a handle on risk.
So what are some of the other types of risk?
The most important, I guess, would be market risk at the general level of decline for the overall market. If the stock market crashes, like the financial crisis. So we think about that when you're investing in stocks and they're volatile. What volatility really means is losing money in the short term. And the reasons why that could happen, different risks that could cause it would be concerns about rising interest rates. Financial assets go down in price when interest rates go up. Interest rates are like gravity to financial assets, so the stronger the rate, the more it's going to pull down the prices of the financial assets. So interest rates are a big risk. If we have higher and higher interest rates, that's going to make stock prices, certainly not go up as much, and they may come down quite a bit if we have big rate hikes. That's a huge risk. Our interest rates are managed by the Fed, and they can print a lot of money to lower interest rates, but that's inflationary. So there's this balance. So if you start to see high inflation numbers, that means they're going to have to raise rates, and they can't lower the rates to keep the economy going. These are the types of things on a macroeconomic level that people worry about, that Wall Street, you hear about it all the time, what's happening with the Fed and inflation, growth in the economy. Those are things that people worry about that cause the markets to do what they do.
What about currency risk?
Currencies is relative, country by country, different currencies. And that's another factor in how different countries, different central banks are managing their money. If they're printing a lot, that can be inflationary. And if they're raising interest rates to slow down the inflation and the currency, people don't really think. There's a lot of confusion about how that all works. I think different economists have different views. So when people say they're worried about the dollar, the first thing they may be thinking about is relative to other currencies. And that's just country by country. Is the dollar strong? Is the dollar weak? That's a relative to other currencies. When you get into concerns that the dollar is going to no longer be the world's reserve currency, and there's a lot behind that. What does that actually mean? It's about the central banking system. The dollar is the currency that the central bank managed the banking system. So if you start talking about the dollar may no longer worries, concerns, risk that the dollar may no longer be the world's reserve currency, that's not something that can happen easily. And I think there's a lot of confusion about that. If the dollar no longer becomes the world's reserve currency, we've got a lot more problems than that. You're talking about wars at that point, and major wars. So we are not going to give up control of the financial system being in the, reserves being in dollars. If we did, we would be essentially losing control over our ability to manage the economy and control over the country. So at that point, you're really talking about the end of the United States as we know it. So there's a point where, when we talk about risk, when does it get to a point where you just have to say that's a risk that's just something that we can't control, and you have to make a judgment at some point. Look, we assume that the United States of America, and I firmly believe this, that the United States of America is nowhere near ending. We've got a long way to go, and there's no way that this country is going to come to an end within the next 100 years. And anytime we make investments in businesses, the furthest we go out when we're valuing a business is to assume that the company, a really good company, you could say might last 50 years. I mean, there have been companies like Coca-Cola, I've used it as an example, that it's over 100 years old. Lots of companies, they're good companies, they've been around a long time, they've got a very strong durable competitive advantage, and so sustainable businesses that aren't going to go away, you can assume pretty easily that they're going to exist for another 50 years. We never go further than that with our assumptions, and we certainly would believe that the United States is going to exist for at least another 100 years for sure.
So what about liquidity risk?
You've got too much in illiquid assets. You may be asset rich and cash flow poor. Sometimes we run across that where, say an investor, they've got a lot of money and high net worth, but it's all in real estate that's not easily sold, and they have rents coming in. Those rents may not be as much as you would think. So let's say you've got a net worth of $10 million, but your properties, the way they're designed, you're not really renting out a lot. It's just a lot of land, or it's a lot of unrented property that has value, but it's not generating much cash flow. So there's not much liquidity there. You don't have the money to get your hands on. That's what liquidity means. When we invest for clients, it's only very rarely that we would invest in illiquid assets, and it's only usually when the client really has a strong desire to do that with a small portion of their portfolio. But we really focus on liquid investments.
So with all these things to worry about, what do we do to help clients figure out what their investment objective will be?
Risk tolerance is a function of your goals and what type of returns you need and how much short-term volatility, how much short-term downside is appropriate. I think I've used an example of, someone's working and saving throughout their whole life. When they're young, you can take more risk generally because, you do have a longer time horizon, and if you've got 30 years before you're going to use the money, whether it goes up or down, and you've got a long life ahead of you, a long career with lots of future earnings, you can have more risk. And so typically in the younger years, you would have high risk. But as you get closer to retirement, it becomes a bigger and bigger nest egg. You're running out of time to be able to take a big hit. So, if you're in your late 50s, you might not want to have all of your money in stock. That's the highest growth we would do, to have all your money in a good portfolio of good businesses that's going to grow. That's really the way to grow and beat inflation over time, is to own a good portfolio of good businesses with pricing power, sustainable competitive advantage, all those things we talked about with our businesses. Once you get to be in your late 50s and you really decide, I'm getting closer to retirement, I really can't ride out another financial crisis. So in the short run, I want to limit my downside in the short run, because if I had all my money in stocks, I don't have enough money saved up to where I could take a big hit. So let's say you need, $3 million. You really can't go below that, but you only have $4 million. Well, that tells you, you could only go down 25%. So you really can't take a full hit in the stock market in the short run. But if you had 50 million and you only need 3, why not have it all in stocks? So I talk about that as, when you're saving for retirement, it's like a rocket. You've launched, you're heading up in the atmosphere, and some people get to the point where they've saved enough where they can retire, but they can't continue with the risk. They have to reduce the risk because now the earnings their earned income has gone away, and so they really need that nest egg to be safer. But some people have built up their net worth so high that I would say they're out of the atmosphere, and they have enough. Even if we had another financial crisis and they had all their money in stocks, they're basically out in orbit, and there's no way they're ever gonna hit the ground. So if you've launched up to a net worth where you have significant assets to where you can continue to have all stock portfolio, that can be appropriate. So given all these things we could worry about, Kathy, how do we help clients determine the right investment objective?
It's a mix of psychology, financial situation, and how much time you have before you need to use your money. We collaborate with clients to find the right balance between growth and protection, and we make adjustments when circumstances change. So we work within a level of a scale from 1 to 5. 1 is less risky, and each level grows in risk through level 5. For us, a level 5, which we call aggressive growth, is a portfolio invested in 100% stocks, usually 25 to 30 businesses that meet the stringent criteria of our portfolio managers. In the universe of investments, there are many things you could invest in that we would consider speculative and would be much greater in risk than the strategy we employ. A step down from level 5 is level 4, called growth, but it's still a high tolerance for risk. It could be a mix of stocks and bonds or a partially hedged stock portfolio. Level 3 is called growth with income, and it's a mix of stocks and bonds or a fully hedged stock portfolio. Level 3 is moderate risk tolerance. Level 2 is low tolerance for risk, and it's called income with moderate growth. It is mostly bonds and treasuries. Level 1 is income with capital preservation, no stocks, only money market or CDs, and it is the most conservative, lowest tolerance for risk. So how do you know what your risk tolerance is? A good place to start is with an emotional check-in. So how would you react to a 20% drop in your portfolio? A, panic and sell. B, feel uneasy but hold. Or C, see an opportunity to buy. So here's another question. Do market fluctuations stress you out? A, yes, I check my portfolio daily and I'm elated when it's up and distraught when it's down. B, I feel occasionally concerned but I'm committed to stay the course. Or C, I focus on the long term and am unbothered by short-term losses. If you're trying to figure out what the right amount of risk is for you, don't limit your decision to the emotional risk tolerance alone. You could have a high risk tolerance that could lead you to bad results based on your circumstances, or you could have a very low risk tolerance that would hamper your long-term growth. So in addition to thinking about your emotional risk tolerance, consider your time horizon and the need for liquidity. When will you need the money? If it's within 3 years, safety and liquidity are key. If you have 5 or even 10 or more years, you could consider more risk in your portfolio, potentially to achieve higher returns. A third consideration would be your financial goals. If your goal is to grow in preparation for retirement and you have a long time horizon, then you should lean toward a 4 or 5, growth or aggressive growth. If your goal is to grow your wealth to leave to your heirs or to a philanthropy, then growth or aggressive growth are also appropriate. If your goal is for your investments to keep up with inflation, then you could consider a level 3, 4, or 5. A lot of times there are people on the radio that are talking about these topics, and they are not fiduciaries, they are not licensed like we are, and so they can say pretty much anything without a compliance department telling them what to say and what not to say. So I heard one of these guys say that stocks are riskier than mutual funds. Do you want to talk about that for a minute?
Okay, well, it depends on the mutual fund. I really think whoever said that was saying what he really meant was having a diversified portfolio, whether it's in a mutual fund or if you own it directly, your own individual investments in your own portfolio, that's less risky than owning one business. There's truth to that, for sure. Depends on the business, but some businesses own diversified portfolios of stocks. So it's not that simple, but don't fool yourself. If you own one stock, the likelihood that you've got a lot of risk, that's very, very true. There is an optimal level of diversification, and it's there for a reason, because you may think you know this business really well, you may be convinced that it's a great business, but when you own just one business, there's things that could happen that just, you need to diversify, because you never know what could happen to that one business.
So I hope that's a good illustration of what we do here. If you would like to have a conversation with us about the right investment objective for you, or if you have any questions, please don't hesitate to reach out. We'd love to hear your thoughts in the comment section below. So don't forget to hit the like button and subscribe to our channel. Our mission at Healy Wealth Management is to improve the financial well-being of our clients by addressing your wants, concerns, and problems with wise counsel and sound investing. Thanks for joining us. We'll see you on the next video.